Hi everyone, thanks for tuning into my channel. This is Sandeep Anand. There is this raging bull market which is currently on. And I was reading an article where Robinhood has reported record volumes in trading and significant upsurge in the number of new registered users, investors, traders, and all of that community. Same is the case with Fidelity, same as the global phenomenon because this is a global bull market which is currently on. But I have a question. Why does Warren Buffett goes out of fashion when typically when we are in the raging bull market, the one that's going on, similar to that? And it's even more pronounced during when it is tech oriented bull markets more than commodity oriented. And we have seen an article in 1999 which was published by Barron's called "What's Wrong, Warren?" But my question is different. What's wrong, investors? For long term investors, do we need to start treading cautiously from this point on? Is there any signal that we need to take away from this raging bull market? History does not repeat, but it certainly does rhyme. So said Mark Twain. I've done a quick analysis to bring some points of view. Take a look. So this article I'm talking about, which was published by Barron's in December 1999, just around the corner when Nasdaq peaked, few months after that. The title was "What's Wrong, Warren?" And when the bubble burst, actually Nasdaq bubble burst in 2000, it wiped out nearly 80% of Nasdaq's value, and the index never returned to that value for many years after that. Now, again, we can see that Warren Buffett is going out of fashion in the last couple of years. It's even more pronounced in the last 6 months. But still, the markets are holding on. I'm not saying that it has crashed or it's any signal to that. But why markets are holding on? It could be because of the stimulus. It could be because of the excess liquidity. Whatever the reasons we can attribute that to. And look at the number of articles I have collated in the last 3 to 4 months that's come. See, starting June, has Warren Buffett lost his mojo? Has Warren Buffett, lost his mojo? Again, another title. And there is, other titles from Barron's. You can see CNN, Investors, News Blog, all are talking about his mojo, his Midas touch, and has he lost his touch? This is another famous statement. So, all these articles have been circulating in the last 3 4 months. There are a lot of naysayers. There are a lot of people who are, talking about how bad Warren Buffett's investment philosophies are, and it could be some signal that is nearing. And we can never predict the peak of the bull market or bear markets. It is really tough to time the market. And I go by the statement that John Keynes has made: markets can remain irrational longer than you can remain solvent. So this craziness, frenziness, whatever is going on in the bull markets can go on for a long time, or it could collapse anytime. So, but now getting into the anatomy of a bubble, and there is something famous called the greater fool theory, which is the typical signals of bull market. Now, what does the greater fool theory says? Buying worthless stocks at insane prices, hoping that someone else will be bigger fool and buy the same stock at even higher price. Now, we might not be really thinking this way when we are investing, but our thoughts would be like, look, the fear of missing out, the FOMO principle, because of which, when there is an irrational exuberance all around, people are making money in no time, we will have the fear of missing out. And that causes us to buy things which are going up irrationally higher prices, thinking that the price will further go up. That is what is greater fool theory. And when, what do you mean by prices going further up? There is a demand and somebody else will buy at a higher price and the price will keep going up. And that is look at the anatomy of a bubble I have put down. So there is a valuation in the y-axis, time in the x-axis. So the stealth phase, then there is awareness phase, then there is mania phase, then there is blow off phase, right? And this goes through this climbs the wall of worry, as they say. The bull market climbs the wall of worry. So you have media attention in the mania phase, starting with enthusiasm, a lot of public participation. We can see that happening currently. Robinhood and others seeing record volumes. There will be greed where people will continuously buy, and we have typical examples of many futuristic companies doing that right now. Then there will be delusion, then followed by a new paradigm. People call this as a new paradigm. It was the dot-com bubble. Right now it is called the digital shift and all of that. And then there is denial when it starts falling down, thinking that it's a correction. And then the way to return to normal, it is caused by fear. Fear psychosis that causes the cycle. And there is capitulation all around for taking out the money whatever we can get when there is a fall. And then finally it returns to the mean, which is the norm in the markets. Mean reversion is bound to happen, it's inevitable. And there is despair all over, and this whole generation of new investors just goes out and never returns back to the market, thinking that it's all a trading place. Now, Howard Marks, if you have read the book, Mastering the Market Cycle, a great book, where he says, history doesn't repeat itself, but it does rhyme. He's quoting Mark Twain. So we are seeing over and time and again, this kind of principle. And typically when Warren Buffett goes out of fashion, there is some signal around. And but at the same time, bull markets should not be missed out. Like it's a lifetime opportunity to change the future. So we all need to participate in bull market. We all need to get advantage from that, and we need to learn how to do that. Now, the main principle is learn but don't imitate. From the great investors, learn great investing principles from all legendary investors, including Warren Buffett. But bad imitations disturbs wealth creation. So, for example, almost all Warren Buffett disciples don't invest in tech stocks, imitating the guru. But tech and digital are not in his circle of competence for Buffett, but it doesn't have to be for all of us. So, bull markets are lifetime wealth creation opportunities. So, and it can change people's future and shouldn't be missed participating. Most of the famous investors became rich participating in bull markets. It should not be missed out. But at the same time, we have to tread cautiously. Now, how to participate in the bull market? We could see that, first have your own investing psych and rational. And that's what I'm saying, imitations are bad. And digital bull markets that started 3 to 4 years ago actually has accelerated pace in 2020 and would attain frenzy valuations in the market soon, if not already. Now, timing the top and bottom are close to impossible. So systematically invest over multiple months during bear markets, systematically invest during bear markets, and systematically withdraw during the peaks as we attain peaks, which is very important to play this safe. And when it's going to the peak, as it's nearing, its frenzy is catching up. It's very easy to recognize when it is nearing peak. We can't time the exact movement, but we can know the directional way it is going upward when it climbs the wall of worry. And during frenzy valuations, fundamental analysis is very important to determine if the valuations are frenzy or not. But you don't have to take out all, plug out all. It could be a systematic withdrawal, which would help taking profits at certain stages of on the way up. And diversification is very important, which is the key, and people often ignore this topic. So diversify across asset classes, including equities, bonds, gold. Best strategy for current bull market, which is going on the digital front, is to have a portfolio allocations of max, say 20, 30, or even based on the risk behavior, could be up to 40% in the digital economy stocks, like the cloud, like the e-commerce, like the electric vehicles and all of that for the next 5 years. And have some old economy quality stocks, which are at some value at this point, which are not in the frenzy valuation zone, to have some of them like 30-40% in your portfolio. Have a couple of global focused ETFs to diversify country risk, like 40 to 60%, including the emerging markets, developed markets and all. This way we can participate, and we slowly and cautiously tread forward, and that is a way to create wealth safe and sound. So this is the message I wanted to pass through, and hope you really like this video, and thanks for staying with me till now.